get to the Central Bank of Nigeria under Mr. Cardoso's leadership, making its first interest rate decision on Tuesday next week, February 27th. The world's going to be watching. Coming against the backdrop of the fourth quarter GDP results, 3.46% in the fourth quarter for 2023, 2.74% full year released Thursday, and we are at practically 30% inflation headline in January, 29.9%. We put all of that together and more for the markets. Joining us now, who better than Mr. Johnson Chukwu, Group Chief Executive Officer at Cowry Asset Management. Oh, I'm looking forward to this conversation because it's always a wealth of knowledge speaking with Mr. Johnson Chukwu. Good evening, sir. Good to have you. How would the latest GDP figures for Q4 2023 play into the considerations for the central bank meeting early next week, in your view?
Well, thank you, Lotus, for having me. It's always also my pleasure, always being interviewed by you and Bosin. I think the figure, in the first place, the central bank has actually taken a clear position on what direction they will take as it relates to monetary policy pronouncements or announcements. If you look at what has happened in the money market, you observe that the central bank has been very aggressive with mopping up liquidity from the system, which means central bank is not particularly worried about economic growth. Central bank is clearly focused on price stability. One, stabilizing the exchange rate. Two, reducing inflation rate. You mentioned inflation at 29.9%. So, and the GDP coming at a rate of 3.46% in the fourth quarter of last year, and the 2.74% for the entire year, actually bolsters the confidence of the monetary authority that even if there is some level of contraction, the economy will not tip into a recession. So clearly, they had taken clear positions to reduce liquidity in the system, to adopt very severe contractionary monetary stance. And a GDP growth rate of 3.46% gives them the assurance that, after all, the economy's performance is not too bad. The reality of it is that the measures they're taking now will lead to a slowdown in the economy. But if that slowdown does not tip it into the negative, I guess they wouldn't mind.
Now, so as far as the other key factors that will influence how the MPC decides, is inflation number one, or exchange rate? It seems like they are the twin-headed dragon that they are facing next week.
I think as it stands today, they are confronting both head-on. Measures to fight inflation will also have a positive impact on exchange rate. If you withdraw liquidity, I'll give you an instance, Lotus. In the past 2 weeks, last 2 weeks ago, the central bank withdrew 1 trillion naira by way of treasury-based issuance. This week, they've withdrawn 1.5 trillion naira by way of treasury-based auction. That's 2.45 or 2.5 trillion naira in the fortnight. There was also a bond offer. The central bank the federal government actually wanted to raise about 2.5 trillion. Of course, they couldn't meet that. But like I said, yesterday, 2 days ago, they withdrew now 1.5 trillion from the system. This level of withdrawal, if you talk to bankers today, they will tell you, as it stands today, the banks are as fasted when it comes to liquidity. Many banks are struggling to maintain the liquidity. Many banks have gone to the standing lending facility of the central bank to support the operation. So clearly, banks are not lending, and the banks are not lending. It has impact on inflation in terms of the available liquidity pursuing available goods, but it also has impact on exchange rate. Remember, part of the problems we have with exchange rate is also reflecting in inflation. The pass-through effect of naira devaluation, the continuous naira depreciation, is reflecting in the price level. So you can use about the same tools to fight these two factors. But the converse is that when you fight these two factors, the converse is that your economic growth or economic performance will be adversely affected.
Now, so based on that, are we pretty much set for a rate hike on Tuesday? And because based on this, on the inflation part of the discussion?
It's almost certain that the outcome of the decision of the Monetary Policy Committee will be to increase rates. Remember, currently we are at, I think, 18.75%. That is the MPR rate. And we are talking an inflation rate of 29.9%. And as we speak today, Treasury bills auction, the last auction of Wednesday, was at 19% for the 364-day bills, which means Treasury bills yield is currently above the MPR rate. So I think, and every other interest rate that matters in the economy is now above the MPR rate. So the central bank must align MPR with the current interest rate environment. And as it stands today, if the central bank, the banks have to come to the borrow from the standing lending facility of the central bank, they will borrow at MPR plus. So if they increase MPR now, that means the bank will also find it more difficult to borrow from the standing lending facility. And that will further constrain the ability of the banks to create credit or to lend to commercial borrowers, which will further slow down liquidity available for FX, as well as slow down the pressure on FX. And any slowdown in the pressure on FX will have an effect of slowing down the depreciation, the increase in inflation rates coming from the pass-through effect. Of course, there are several factors impacting on inflation rates. This is just one of them. But the key thing is that if you're dealing with one, at least you're dealing with one of those variables. The other variables could include issue of food prices. We saw a food inflation about 35% in the month of January. But clearly, that may not be fought with monetary policy too. It has to be fought with production, food production. But we're going to deal with at least about one of the four variables that are impacting on inflation. The second variable that is impacting on inflation is the ways and means funding of the federal government by the central bank. The central bank said they won't lend further to the federal government, and the federal government pays off existing loans. The third factor is the conversion of earnings from crude sales into naira at higher exchange rates. And that's why if you look at the sharing allocations going to the three tiers of government, you see what they call exchange rate gain. And that has kind of boosted liquidity beyond the productive level of the economy. So these are some of the factors. We're dealing with one. Hopefully, we can deal with food production. If we deal with food production, we will put a hang on the inflation pressures.
Thank you so much for the excellent breakdown. So this is why we have you on the show. I really want to ask you this. I want to get your thoughts on this next thing. The central bank is planning a conference call with international investors later this week. Now, I want to ask you what should be the key message of the CBN. But Mr. Johnson, before I even get there, should that be the job of the CBN to be talking to investors? Because I want to throw two things at you. One, there's a chip company in Taiwan, TSMC. They are planning a $20 billion chip factory that they're going to build in Japan. Japan's Minister of Trade and Investment was on Bloomberg talking about that deal. And then Egypt has just signed a deal, I think, with the UAE. They are expecting $35 billion in the next 2 months, two tranches, I think 25 billion and then 10. Their own minister of, I believe it was Trade and Investment, that was making that announcement. So what do you make of this call? Before we even talk to their key message, should it be the CBN that should be having this call, sir?
I don't think it's the role of the central bank to go and start scouting for investors. It's clearly not their role. I think it's a misnomer that the central bank, whose primary duty is maintain price stability, manage the financial system liquidity, stability, ensure that price levels are stable, and as the U.S. Federal Reserve also includes supporting stable economic growth or economic growth. Those are the primary roles of the central bank. The duty of attracting investors into an economy is that of the Federal Minister of Trade, Federal Minister in charge of Trade and Investment, and other executive arms of government. It's not the monetary authority that should do that. But we have been dealing with this misnomer for quite some time. If you remember right from the time of the Lamidi Sanusi, it was the central bank that went even to the extent of building hostels in the universities. And then, in the immediate past, CBN governor, Godwin Emefiele, the Federal Central Bank was actively involved in lending to all sorts of activities, anchor borrowers program, commercial credit, agricultural credit scheme, and what have you. They were funds meant for several entity, including the entertainment industry. So we have been living with a situation where the central bank goes beyond its primary call of duty to get involved in what should ordinarily remain the primary purview of the fiscal authorities. But ideally, it's your Minister of Trade and Investment that should be doing that, selling the attractiveness of the country's economy to foreign investors, and maybe supported by the Minister of Finance, who should come up with policy pronouncements on how the fiscal tools of the government, the budgetary tools, can be used as incentive to attract investors into the economy.
Thank you so much. So, okay, so, well, since you've now laid the groundwork, it is what it is. That's the misnomer. So now my question about what the central bank's message should be to these investors, what do you think should be the key message here?
Well, for investors, they hear they're going to talk to the central bank governor. They will ask central bank governors questions related to his primary function. One of which would be what measures the central bank taken to clear the areas of forwards. That's what concerns investors. That's what makes investors want to look at. Has this economy stabilized to the extent that I can bring in my money into that economy? They will ask the central bank governors what effort the central bank is making to bring down inflationary pressures, stabilize the exchange rate, restore liquidity in the FX market. Those are the primary functions of the central bank. And that's where the questions will focus on. And that's what the central bank governor should prepare to answer. They're not going to ask same questions on how can I get concession to build the standard gauge rail from Lagos to Ibadan or Lagos to Enugu. They're not going to ask those questions. They're not going to ask questions on how do we explore the solid mineral resources of the country and invest in those sectors. Those are the primary questions that should apply to the Minister of Trade and Investment, Minister of Finance, and other arms of the other ministers of the executive arm of government. So the central bank governor should prepare to talk to the world on what we're doing to stabilize the Nigerian macroeconomic environment. The price stability, particularly as it relates to exchange rates, inflation rates, those are key questions. Clearing the areas of forwards that have not been cleared. Currency swap that we are entered into by previous administration of central bank, what are we doing to resolve them? So that at the end of the day, investors who are coming here will be certain about our level of foreign exchange reserve, and they can measure the risk they are taking. And once they have achieved clarity on that, we should begin to see investors. And they will also ask them, how do we want to achieve real positive return on short-term investments? Anything outside that will clearly not be the responsibility of the central bank governor to focus on.
Thank you so much for that. We look forward to that call next week. The stock market, another area you have a wealth of knowledge on. What have you made of the red hot starts to the year? Do you see a correction around the corner for the equities market?
Notice, I've actually said this repeatedly, and I keep saying that currently the market seems to be the market seems to be overvalued, and as it may not cut across all the counters, but clearly there are some stocks that have their current prices are completely beyond their intrinsic worth. I did some analysis in our research unit, and we realized that some stocks have, if you look at their price earnings ratio, your NAC, if you look at the NAC, they have NACs of less than 1%, some 2%, which simply means that the return on investment, if you buy them at the current price, is less than 1%. Some have negative NAC, and those companies that have negative NAC, because even in their full year unaudited accounts, they are declaring losses, and people are still bidding up their prices. So you're asking yourself, what are they buying into? Is it expected stream of future cash flow from these companies? But you still have some that have very high NAC yield, which could mean that buying into those stocks will actually give you good return on your investment. So it's not a blanket thing, but investors are investing blanketly, and they are taking the syndrome approach. Anything is a penny stock is a good stock. So clearly, the market gained, remember the market gained 45.9% last year. As at close of business today, the market had gained more than 35.5%. So if you add those two, you are saying the market has gained over 80% in the past 13 to 14 months. And you just mentioned the GDP growth grew at 3.46% in the last quarter of last year. And the GDP grew at 2.74% entire last year. So what will propel the market to gain 80% when the GDP performance on average is 2.74%? That is no-brainer that at some point, by the time the full year results are being announced and investors can see clearly that not all the instruments that they invested in, not all the security they invested in will give them the kind of return they were expecting, I think we should expect some correction.
Okay, thank you so much for that. US dollar mutual funds. I mean, you've already talked about the liquidity issue with FX, and I guess it looked like people are turning in that direction. How do you see general interest for those dollar-denominated securities?
I think most of them would have enjoyed some level of improved patronage or investor preference, principally because the kind of depreciation we saw in the local currency until the last few days was frightening, and there was flight to safety. So investors who had access to foreign currencies would ordinarily invest in foreign currency assets, and that's the mutual funds are one of the few foreign currency legitimate assets you can invest in the country, other than leaving your money in your domestic account that is non-any income. So the options the investors have are either you buy mutual funds or you buy a dollar note, or you invest in Eurobond, assuming you have a reasonable level of financial resources to invest in Eurobond. But if you don't have that level of capital to invest in Eurobond, then you could invest in Eurobond indirectly through a mutual fund, a Eurobond mutual fund, a dollar mutual fund. And I think most of those who are managing that, we manage one of such funds. In fact, we manage $2 funds, a Eurobond fund and a dollar fund note. And we've seen a sharp increase in investors' appetite for these instruments.
Thank you so much for mentioning that. So I really want to, I'm always trying to pick your brain on a number of issues. The government has said repeatedly, particularly Wale Edu, Minister of Finance, he says there's an executive order out there that they are planning on incentivizing the Nigerians with domiciliary accounts. You just mentioned DOM accounts sitting in there idly, not earning any interest. They want to do something to incentivize, and to me that sounds like an interest-bearing security. But if you have the Cowry asset managements of the world and other banks that are offering dollar-denominated securities, what do you think they could be doing here? Are they going to offer? Is it going to go through parties like yourself, or this is the government? I mean, it's like a mystery. What do you think the government is planning on doing to incentivize people with DOM accounts and maybe even diaspora Nigerians to invest in bring their dollars out, essentially?
Interestingly, the Federal Minister of Finance does not have license as a fund manager, so they can't issue any fund. What they may do is to partner with institutions like Cowry and such other financial entities to promote a Diaspora fund that is dollar-denominated and encourage Nigerians in diaspora that want to remit money, including some Nigerians who are holding balances in their domiciliary account, to invest those funds in longer-dated instruments. You really also can't rule out the possibility that the DMO can come up with a dollar fund. The Debt Management Office can actually come up with a dollar fund, a long-term not dollar fund, and therefore they will use it to sterilize the liquidity they have in many domiciliary accounts, not by force, by coming up with yields that are attractive to investors that will make those who are leaving their money idle in the domiciliary account to invest in those instruments. Remember that the federal government also have Eurobond, but I don't see the federal government coming to issue a fresh Eurobond in the market because the appetite for a Nigerian foreign currency debt instrument will be very weak now, and the pricing will be very steep, so the federal government can't afford that. But they can come up with something similar to the savings bond that the federal government has issued, which clearly was a way of incentivizing slow savers or low-income earners to save, those who can afford light ticket deposits to save through the federal savings bond. I think you can't rule out that. But ordinarily, I think the more appropriate thing is allow the private to play in that space and partner those private sector funds that are already in existence to, and as well as adopt some public awareness creation that will make those who have balances in domiciliary accounts to recognize that those balances have the potential to earn income for them and that the instruments available in the market for them to invest in those instruments.
Fantastic. Well, so much to look forward to. Mr. Johnson, I guess we're out of time. I mean, what's your outlook as you look at? I know it's February, it's still very early in the year. How do you see things turning out in 2024 with all that's going on next week and beyond?
Well, I think the economy will continue to struggle throughout 2024. Some of the policies, we've seen a lot of firefighting by the government, particularly the monetary authorities, coming up with a raft of policies almost on a daily basis. Some of those things, the market reacts spontaneously. You have the news effect on some of them. We need to see the heavy lifting. We need to restore liquidity to the foreign exchange market. That is core. Everything we're doing is demand management. There has to be supply management. Now that supply management is very critical. If you do not supply, you're going to have some depression in demand, but also the demand will come up again. You need to deal with not just demand management, but also deal with supply management. But ordinarily, because that supply may not increase so much. Yes, we've seen improvement in crude production. I mean, when I looked at the GDP figure for last year, I saw that average crude production was about 1.55 million barrels a day, an improvement over the 1.34 million barrels we saw in the fourth quarter of last year. In 2022, the fourth quarter of 2023 had 1.55 million barrels, which is why we saw that oil and gas sector grow by about 12%, the first in a long period of time. So if we could have crude production ratchet up, then we could see an improvement in supply. But if that is not done, what we're dealing with is just forceful management of demand. It may not endure for too long. So I think the economy will not wobble through the year. If you remember Fanny Amo of the what do you call it, Baby Eagles, then she said we will wobble through. But the problem of wobbling through is that if you encounter any major resistance, you fell out of that competition, which is what happened to Nigeria last year. So, but I think the outlook for the economy is still uncertain.
The Group Chief Executive Officer of Cowry Asset Management, Mr. Johnson Chukwu. Always a pleasure talking to you, sir, about the economy. Thank you so much for your time.